Okay, so let's get right into it. Have you ever been in a trade and felt like the market is moving against you with, I don't know, almost surgical precision? Well, what if I told you it's not random? Not at all. It's a hunt. And today, we are going to break down the exact map used by the hunters.
This right here, this is the single most important rule of this entire game. It's the whole reason we're here, really. Because in the markets, you're either at the dinner table or you are on the menu. Simple as that.
So, to flip that script, to go from the hunted to the hunter, we first have to understand what the big players, the smart money, are actually looking for. What's the fuel that drives these massive, lightning-fast market moves?
Well, it all comes down to one word: liquidity. Just think of it as these giant pools of money that are just sitting on the sidelines. They're made up of pending orders and, this is the crucial part, stop losses. See, for every winner in a trade, there has to be a loser. So when a regular trader gets stopped out of their position, their loss becomes the other side of the trade for a huge institution. It's how they can get into their massive positions without completely blowing up the price. And this slide just perfectly illustrates how they get that liquidity. It's called a stop hunt. You know, an institution that wants to sell short can't just slam the sell button on millions of dollars at once. So what do? They engineer a sharp move up, just like you see here, specifically to run through an area where they know retail traders have their stop losses. This triggers a huge cascade of buying, which gives them the exact liquidity they need to fill their huge short positions before slamming the price back down. It is not random, it's a calculated, deliberate move.
So that kind of begs the question, right? How do these institutions know exactly where all those stops are located? Well, ironically, it's because a lot of the common trading strategies we're all taught unintentionally create the perfect targets for them. Let's take a look at how this trap is actually set.
Okay, just look at the two scenarios here. On the left, that's the classic retail mistake. A trader sees a support line, they put their buy order right on it, and their stop loss just below. What happens? Price comes down, punches right through that support, stops them out for a loss, and then it reverses. They just became the liquidity. Now, look to the right. The smart money trader does the complete opposite. They wait for that trap to spring, they wait for the price to sweep below the support line, grab all that money, and only then do they look for their entry. They trade the sweep, not the level itself. Big difference.
And this is where it gets really clever. This slide shows a concept called inducement. This is basically manufactured liquidity. Smart money will often create a small, really tempting price level, this fake support you see here, just to trick people into getting in early. This creates a brand new, fresh pool of stop losses right above where they actually want to buy, which is that order block down below. They are literally baiting a trap to build up the fuel they need for their real move.
All right, so we've covered the what and the why. Now it's time for the where. We're about to go on a tour of the 8 key zones on any chart where these pools of liquidity predictably stack up. This is basically the institutional map of the market.
So let's start with zones I and I2. Equal lows and equal highs. I mean, these are your classic textbook support and resistance levels. And because they're so obvious, they attract the most traders, which means they have the most stop losses sitting just above or just below them. So here's the kicker. The cleaner and more obvious a level looks, the more dangerous it probably is, because that's where the most fuel is sitting. Next up, you've got the classic retail traps. We're talking trend lines, old support and resistance levels, and those standard Fibonacci levels like the 50% or the 61.8%. It's kind of wild when you think about it. The very tools that most trading books tell you to use are what create this predictable behavior, and institutional algorithms are literally programmed to hunt these exact zones for stop losses. Okay, now we're diving a little deeper into the more algorithmic layers of the map. Zone VI is the previous day's high and low. These are huge pivot points for automated trading bots. And Zone V7 is session ranges, like the high and low of the Asian session. High-frequency trading algorithms are specifically designed to target these time-based levels for liquidity sweeps when a new session, like London, kicks off.
And finally, we have Zone 4, which is, well, this one's a bit different. This isn't a trap, it's a clue. It's called an order block. This is an area where a massive institutional order was placed in the past, and it left behind an imbalance in the market. You can think of it like a footprint they left behind. And price has this natural tendency to get pulled back to these zones, almost like a magnet, to fill the rest of those old orders. This is our target.
Okay, so we have the map, we know all the hunting grounds, but, just knowing where the traps are isn't enough. We need a solid, actionable playbook to trade with the institutions, not against them. So let's build this out, step by step.
And here it is. I want you to think of this as your pre-flight checklist. First, trend. What's the higher time frame direction? Second, POI. Where's our institutional order block? Third, inducement. Where's the liquidity building up? Fourth, sweep. We wait for price to take out that inducement. Fifth, confirmation. We dive into a lower time frame. And finally, sixth and seventh, entry and target. We execute. You cannot skip a single step.
So let's see phase 1 in action. We're on a higher time frame chart here. Step 1, we can see the trend is clearly bearish, right? Step 2, we find a clean order block, our point of interest. And step 3, and this is maybe the most important part, we wait. We do not just place a limit order and hope for the best. We simply watch as price creates that inducement, building up that pool of liquidity right below our POI. We're just watching the trap being set.
Now for phase 2, the precision entry. As soon as the price sweeps that inducement and taps into our high time frame order block, we immediately zoom into a lower time frame, like the 15-minute or even the 1-minute chart. And down here, we are looking for a change of character, a clear structural break that confirms the big institutions have stepped in and are turning the ship around. That confirmation is our green light, and it gives us a brand new, super precise order block to enter from.
You know, theory is one thing, but let's see how this all clicks together in a real-world example. We're going to dissect a trade from start to finish and really see how you can go from being the hunted to being the hunter. So, here's the story of this trade. The overall trend was down. Then, price created these beautiful, clean, equal highs. That's our inducement. It looked for all the world like a breakout was about to happen, tempting buyers to jump in. But we know better, right? That was just fuel. Price then violently swept above those highs, triggered all the stop losses, and tapped perfectly into that institutional supply zone, that order block, sitting just above. And the result? A powerful continuation of the downtrend.
And here's the execution. After that big sweep, we would have jumped down to a lower time frame, spotted our change of character, and placed our limit order on that new tiny order block. Now look at that stop loss. It's incredibly tight, just sitting right above the high of that manipulation candle. Our target is the next major swing low, where we know another pool of liquidity is resting.
So here's the bottom line. The market is pretty much designed to mislead the majority. But it's not chaos. By understanding this hunt for liquidity, mapping out these 8 key zones, and patiently waiting for the sweep, you can fundamentally change your perspective. You can stop being the fuel for the fire and start trading right alongside the institutions. We've laid out the entire institutional playbook for you. The map, the strategy, the execution. So the only question left is, are you going to continue to be the fuel for the market, or are you going to learn to follow the footprint and hunt alongside the smart money? The choice is yours.